Let's cut right to the chase. Your money is losing value every single day. The $100 bill in your wallet today will buy you less coffee, less gas, and less of everything else next year. That's inflation. It's a silent thief that slowly, but surely, erodes your savings and your financial future. If your entire net worth is sitting in a standard checking or savings account, you are guaranteed to lose purchasing power over time. It's not a matter of if, but when and by how much. So, what's the plan? Sticking your head in the sand is not a strategy. This is your roadmap to a durable, all-weather portfolio, designed to withstand and even thrive during periods of rising prices. We will cover specific assets from stocks, bonds, real estate, and commodities, and how to mix them based on your risk tolerance, conservative, balanced, or aggressive. By the end, you will have a practical framework you can put into action immediately. Before we dive in, a quick word of caution. This video is for educational and entertainment purposes only. It does not constitute financial advice. Investing carries risk. You may lose some or all of the capital you have invested. Results are not guaranteed. Past performance does not guarantee future returns. Please do your own diligent research. Please consult a licensed financial advisor or professional before making any investment decisions. Now, with that out of the way, let's get to work on protecting your money. Before you can fight inflation, you have to understand what it is and why it matters so much. In the simplest terms, inflation is the rate at which the general level of prices is rising and the purchasing power of currency is falling. When the consumer price index goes up by 3%, the typical household basket costs 3% more than a year ago. It's why grandparents recall buying a candy bar for a nickel. The candy didn't become pricier, the nickel became worth less. This matters for investors, especially those saving for retirement. If your investments earn 5% but inflation is 4%, your real return is 1%. You're barely treading water. If a savings account pays under 1%, while inflation is 4%, you're losing 3% purchasing power every year. Compounded over years, that can mean the difference between a comfortable retirement and having to drastically cut your lifestyle. Inflation is a hurdle every dollar must clear. Own assets that tend to rise with or faster than inflation. Cash is directly eroded. Traditional long-term bonds suffer as new issues pay higher rates. Build a diversified portfolio that behaves differently in inflation, for protection from multiple angles. First, own real assets with intrinsic worth, real estate and raw materials. Second, own businesses, stocks, with pricing power to protect margins. Third, include bonds explicitly designed to protect from inflation. Combine these and you move away from a sitting duck portfolio toward a resilient fortress that can weather the storm. The first and most direct tool is Treasury Inflation Protected Securities, or TIPS. Unlike regular treasuries, a TIPS bond adjusts its principal upward with inflation measured by the CPI. Then the bond's fixed interest rate is paid on the new, larger principal. This provides a direct, government-backed hedge. For retail investors, own TIPS via a low-cost ETF or mutual fund. If inflation spikes, the underlying bonds should rise, preserving purchasing power. TIPS are foundational for conservative or balanced portfolios. Capital preservation in real terms. They are the bedrock of your defense. Next, short-term bonds and floating-rate notes. When inflation rises, central banks typically raise interest rates. This crushes the value of long-term bonds with old, low coupons. Short-term bonds are far less sensitive and mature quickly. When they mature, reinvest into higher-yielding bonds, adapting fast. Floating-rate notes reset coupons based on benchmarks like the Fed funds rate. As rates rise, your coupon payments adjust upward. Use ETFs holding short-term bonds or floaters to reduce rate risk in fixed income while still generating income. Together with TIPS, this anchors the defensive side of your portfolio in inflationary times. Over the long run, one of the best hedges against inflation has been owning stocks. Yes, stocks can be volatile when inflation first spikes, but remember what a stock is. It's a partial ownership claim on a real business. That business sells real goods or services, owns assets, and earns profits. With pricing power, Good businesses raise prices to protect profitability. Revenues and earnings grow with inflation, and stock values follow over time. Focus on high-quality companies with strong balance sheets and rising dividends. Achieve this via a broad market index fund, like an S&P 500 ETF. Another powerful hedge is real estate. Most access it with REITs. A REIT owns, operates, or finances income-generating properties. With a REIT ETF, you become a landlord. Apartments, shopping centers, warehouses, offices, without fixing a faucet. Real estate is a classic real asset whose value tends to rise with inflation. Leases often have inflation escalators, so rents and income rise. By law, REITs pay out at least 90% of taxable income as dividends, which can grow with rents. This blend of appreciation plus rising dividends makes REITs a cornerstone for growth with inflation protection. Action: broad index stocks for pricing power. REIT ETFs for real asset income. When people worry about paper money, they turn to hard assets. Commodities like energy, industrial metals, and agriculture. When oil rises, transportation and manufacturing costs rise, and prices get passed to consumers. Instead of storing barrels or bushels, use broad-based commodity ETFs via futures exposure. Supply shocks and geopolitical events can drive unexpected inflation. Commodities can shine then. They can be volatile. Allocate roughly 5 to 10% as insurance. Within commodities, gold deserves its own mention, a store of value for millennia. Gold doesn't pay a dividend or generate earnings. Its value comes from scarcity, durability, and the belief it holds value, especially when fiat faith is weak. When real bond returns go negative and cash yields lag, investors flock to gold. Own via physically backed gold ETFs, or hold coins bars if you can handle storage and security. Gold won't track CPI perfectly, but it tends to perform during extreme stress. Allocate around 5%. Valuable diversification in an inflation-proof portfolio. Let's talk about cash. Everyone needs an emergency fund and some liquidity, but idle cash is a guaranteed loser in inflation. At 0.1%, while inflation is 4%, you're losing about 3.9% a year. Use high-yield savings, money market funds, or short-term CDs, federally insured where applicable. Higher yields might not beat inflation, but they can close the gap dramatically. For more yield, consider investment-grade inflation-linked corporate bond funds. They offer higher yields than treasuries but carry default risk. Size positions modestly. Use as a small slice to boost income and add another inflation defense. Together, smart cash and selective corporates round out your fixed income playbook. There is no single portfolio for everyone. Your mix depends on age, time horizon, and willingness to take risk. Use these 3 templates as starting points. Conservative, focus on safety, income, and direct inflation protection. 50% tips and short-term bonds, 20% quality dividend stocks, 10% REITs, 10% commodities and gold, 10% high-yield cash and money market. Balanced, seeking both growth and protection. 40% stocks, broad index plus dividend growers, 25% tips and short-term bonds, 15% REITs, 10% commodities and gold, 5% inflation-linked corporates, 5% high-yield cash. Aggressive long horizon and high risk tolerance. 55% stocks, broad index plus cyclical sectors. 15% REITs, 10% tips and short-term bonds, 10% commodities and gold, 7% inflation-linked corporates, 3% high-yield cash. Think of these as templates. Tweak to fit your life. Build a plan that helps you sleep well at night. Discipline, rebalancing. Final thoughts. Building is half the battle. Maintaining it with discipline is the other half. Markets are noisy. Headlines tempt rash decisions. The worst move is abandoning your long-term strategy on short-term news. Rebalance semi-annually or when any slice drifts over 5%. Sell some winners, buy laggards. This enforces buying low and selling high. Something will be out of favor. That's a feature, not a bug. Inflation is a headwind, not an insurmountable wall. With tips, short-term bonds, quality stocks, REITs, and commodities, you can build a financial fortress. Start with a plan that fits your risk tolerance, implement with low-cost funds, and maintain it with discipline. Thank you for watching. If this was clear and useful, please like the video, share it with someone who could benefit, and subscribe for more straightforward investing and personal finance content.